Okay, so you've probably heard the word options thrown around, right? On the news, in finance articles, or maybe from that one friend who's always talking about trading. But what are they really? Well, in this explainer, we're going to pull back the curtain and demystify the whole world of options.
If you've ever invested in stocks, you know the drill. It's pretty straightforward. You buy a stock, you cross your fingers and hope the price goes up, and then you sell. Your entire game plan depends on the market going in one single direction, up.
But what if it wasn't just a one-way street? What if I told you there was a tool that gave you way more flexibility? A tool that could actually help you make money not just when things are going great, but also when the market takes a nosedive.
Well, that tool actually exists. And honestly, it's not as scary as it sounds. This is the world of options. And in this world, the strategy is a whole lot more interesting than just buy and hope. All right, so to really get our heads around options, the first thing we have to do is understand how they are fundamentally completely different from stocks.
See, when you buy a share of stock, you literally own a tiny slice of that company. You're an owner. An option, though, totally different ballpark. You don't own the stock at all. Instead, what you own is a contract that gives you the right to buy or sell that stock later on. It all boils down to rights versus actual ownership.
So, what in the world is this contract exactly? To see how options really work, we've got to break down the core definition. Okay, here it is. An option is a contract that gives you the right, but, and this is the absolute key to everything, not the obligation to buy or sell an asset like a stock at a price you agree on today before a certain date in the future. That little phrase, the right but not the obligation, that's where all the power and all the flexibility of options trading comes from. And every single option has three key ingredients that come right out of that definition. First, you've got the underlying asset, the stock we're actually talking about. Then there's the strike price. That's the locked-in price where you get to trade. And finally, the expiration date. That's the deadline, the date by which you have to decide what to do. So now that we know what an option is made of, let's talk about the two basic moves you can make. In the entire world of options, pretty much everything boils down to just two fundamental types, calls and puts. And it's actually beautifully simple. A call option gives you the right to buy a stock at that strike price. So you'd buy a call if you're feeling bullish, if you think that stock is about to go up. A put option, on the other hand, gives you the right to sell a stock. You'd buy a put if you're bearish, if you think that stock's price is headed for a fall. So with a call option, your goal is simple. You want the stock price to climb higher than your strike price. The moment the stock's price crosses that line, your potential for profit really starts to take off. A put option is just the mirror image of that. You're rooting for the stock price to fall below your strike price. The further it drops, the more profit you could potentially make. And that, right there, is how you can make money even when the market is going down. Okay, so having this incredible flexibility, it has to come at a cost, right? Of course. But this is where options get really, really interesting. Let's talk about the risk and the reward. The price you paid to buy an options contract is called the premium. And here's the magic of it. That premium you pay, that is the absolute most money you can ever lose on that trade. Your risk is capped the second you buy it. So let's say you paid a premium of, $200 for an options contract. That's it. That's your maximum risk. It doesn't matter how wrong you are about where the stock goes. You cannot lose a single penny more than that initial $200. Your risk is totally defined and limited. But what about the other side of the coin, the reward? Well, while your risk is strictly locked in at that premium you paid, your potential reward is, theoretically, unlimited. And that's the wild, unique profile of an option, a small, fixed risk for a potentially massive reward. So let's zoom out and look at the big picture for a second. With this crazy risk-reward setup, why do people actually use options? Well, it usually boils down to two main strategic reasons. The first one is leverage. This is the ability to control a huge number of shares with a pretty small amount of money. The second big reason is protection, or what traders call hedging. Basically, it's using options as an insurance policy to protect the stocks you already own from a market downturn. Let's focus on leverage for a sec. I want you to think about a real physical lever, the kind that lets you move a giant boulder with just a little bit of effort. Well, financial leverage works the exact same way. You use a small amount of capital, your premium, to control a much, much larger asset, which is usually 100 shares of stock for every contract. And here's that power in action. Let's imagine you have $1,000 to invest. You could go out and buy 50 shares of a $20 stock. If that stock goes up by $5, you make $250. Not bad, that's a 25% return. Or you could use that same $1,000 to buy options contracts that control 500 shares. Now, if the stock makes that exact same $5 move, your profit could be $2,500. That's a 150% return. That is the power of leverage.
So, what's the final verdict? Are options this incredibly sophisticated tool for growth and protection, or are they just a high-stakes gamble? Well, the truth is, they can be both. It really all just depends on how you decide to use them.